Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Irish tax reform to the OECD's latest developments. I'm Doug McHoney, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and will be licensable in July 2024. On this week's episode of Cross-Border Tax Talks, we're in Prague, Czechia, at PwC's EMEA International Tax, Legal, and Workforce Academy, where I'm excited to have Peter Reilly on the podcast. Peter is a Dublin, Ireland-based international tax partner and PwC Ireland's tax policy leader. Peter, welcome to the podcast.
Hey, Doug, long-time listener, first-time caller. How's things?
It's great to finally have you on. We've been working together for a long time and have been talking about getting you onto the podcast. So very excited to have you on. And I think you're our first Irish guest since I've been really doing the Pillar 2 kind of focused podcast, and certainly a lot to talk about. But before we dive into the Pillar 2 topics, we've been spending some time together in the Pillar 2 context, and I learned that you live in a small town outside of Dublin called Monkstown, just south of Dublin, and that you're the second most recognizable person in Monkstown. Who is that well-known individual, and can you give us the pitch or why both you guys live in Monkstown, Ireland?
Yeah, it's debatable now if he's more famous than me, Doug, right?
Well, before the podcast.
Yeah, before the podcast, absolutely. Yeah, it's Cillian Murphy. He lives a few hundred yards from me. I'm not sure if he knows he lives a few hundred yards from me, but Cillian Murphy from Oppenheimer and Christopher Nolan fame lives around the corner, yeah. Why do we live there? Lucky, nice place to live, right beside the sea, go for nice walks. He brings his dog out, that kind of thing.
Well, that's what you had mentioned. I saw there was a 60 Minutes piece about him with him and his dog, and you had mentioned that you had run into him. And very cool. It looks like a beautiful town.
Yeah, it's
to come
great.
Visit.
Yeah, no, it's greght. I actually did physically run into him one day, which was slightly embarrassing. His dog went one way, I went the other, and I hit him, which was. Yeah, a little bit awkward.
All right.
That's about as much contact as we've had.
Well, very cool. I want to come out and do a walk on the beach at some point, and we'll see if I can have similar fate. I'll try to be a little bit more careful. All right. So let's move into to Pillar 2, and we want to get into some of the details with respect to Ireland, but really wanted to just step back a second and kind of put, let's go back even 10 years when this whole BEPS initiative started, even really before Pillar 2 is a thing. And this was taxation of the digital economy. And then I remember this concept of this 15% minimum tax kind of being introduced or floated around. Maybe that was 2019, somewhere around there. I never would have thought that Ireland at the 12.5% statutory rate, the tremendous success that Ireland has had for decades now, really with informed corporate tax policy. And you have been able to attract a tremendous amount of talent from some of the world's largest companies, including some of the US's largest technology companies. And I would have thought there's no way that Ireland would agree to a 15% minimum tax, given the choices that you've made and the success that you've had. Maybe start with how did this happen? And I know we try to keep this at about a 30-minute podcast, but maybe you could summarize, how did we get here? And I guess there was just so much momentum with the EU directive, but what is kind of your view now that it's enacted, but how did we get here from a political perspective?
Yeah, it's pretty interesting, Doug. If you go back to 1997, right, that was when Ireland decided that we were going to move to a 12.5% rate, and we moved away from an incentives type regime, right, into a low rate, wide base regime, which, in hindsight, and to be fair to the policymakers at the time, was a super move, right, because that was the way that we were going to be able to attract investment and substance-based investment, which really was then what the first BEPS project was all about. It was trying to align substance taxing rights. I was actually in the Department of Finance, so I was working in the Department of Finance at the time of the first BEPS project. And the question that you've put to me is why did Ireland back this? I'd nearly put it back. Why did the US end up backing it, right? Because
fair enough.
I would have said at that time, in the first BEPS project, I think it probably skillfully went nowhere because I don't think that the US were really that far behind Action 1 at the time. I think the momentum then changed. And when you look at, as you said, 2019, 2020, you have a scenario where there's just momentum, right? So there was momentum at the OECD, there was momentum from the US, even though there was probably a question as to whether when the US actually went home, was it ever going to happen? But there was momentum at the OECD. There was also a lot of momentum in the EU. If you remember, Ireland stayed out of the tent for quite a while, so we said we weren't keen on this. I think at that point, I think policymakers in Ireland probably felt that a rate of 12.5%, let's say, was achievable. I think when the writing became on the wall that the only game in town was going to be 15, I think they felt that once they were able to nail down a 15% rate that wasn't going to go to 20, 25, whatever it was, that was probably going to be the best game in town. And then when you add that to, maybe at 15 for large multinationals, we're still going to be at the floor of, acceptable corporate tax. I think the policymakers in Ireland felt, well, this is the best deal we're going to get, and we could still operate quite efficiently there.
Any views how this has impacted the Irish companies that operate, frankly, whether it's inbound or outbound? I guess maybe more specifically for the inbound, but do you think this will impact, or the policymakers view that this could impact foreign direct investment? Do you see people now with Pillar 2 packing up their tents and heading elsewhere?
No. There's always going to be concerns in a small open economy like Ireland, about what's your level of attractiveness for FDI, okay? We have an economy which has, a reliance in some respects on FDI. We have a really, really strong domestic business as well, but they have to coexist, and we've done quite a good job of that. So there's always going to be a concern. We can come on to other things later that, that Ireland's going to try to do. But from a Pillar 2 perspective, I don't think so. I think what's key from a Pillar 2 perspective is that we can be at that floor, right? Mm-hmm. And that there isn't a BEPS 3.0, which I would always worry about, right? So that we have a scenario where Ireland is kind of saying, well, if the new 0, 5, 10, whatever it is, right? If the new rate of an acceptable tax is 15, if you can be that in Ireland, and, there's all the other benefits that Ireland brings from a US perspective, English-speaking common law, all that kind of stuff, well, then we still see the opportunity being significant. And I think the inflow of FDI is still significant. Mm-hmm.
Any idea, or has the Irish government said how much money this could potentially raise? And, one would think that, particularly for given the number of greater than 750 million euro revenue companies that operate either with, foreign parented groups that operate inbound into Ireland, or Irish parented groups, that there are a lot. And then with the QDMTT specifically, that obviously avoids Ireland from having their domestic tax topped up from somebody else so they can top it up themselves. One would think that QDMTT would be a pretty big number, which also ironically, the countries that have implementing the QDMTT and are getting additional revenue are frankly not ones that wanted additional revenue, because presumably if they did, they would have just raised the corporate tax rate. But any idea on how much money this will raise and how the Irish government policymakers are thinking about that?
Yeah.
Are there new roads, and are you guys building new ports, or?
Yeah, we're trying to build a children's hospital at the moment, which seems to be costing more and more every day.
Okay.
I'll ignore that one for a minute. There's a few things to hone in on there, right? The first is the only cost that's been put out on this is actually a cost rather than a profit. Okay,
for Ireland, for
the two-pillar solution.
I see.
So Ireland would see that the Pillar 1 would likely be a cost, and given the number of Pillar 1 entities that would operate an EMEA headquarters out of Ireland, they're kind of saying, okay, so that they're actually estimating a cost overall of about 2 to 2.5 billion. It's hard to understand exactly what's behind those figures, and to be fair to policymakers, I think it's very hard for them to be able to actually figure that one out, right? Sure. I think when you do look at it on a Pillar 2 only basis, I mean, 15 is greater than 12 and a half. Okay, everyone says I'm good at maths, right? So 15 is greater than 12
Get a few
and a half.
accounting adjustments,
yeah, exactly.
Right.
But you know, on a broad basis, do I think that people are going to have to pay QDMTT in Ireland? Yes. So do I think that Ireland could have a bump on that perspective from a revenue line in the short to medium term? I would probably expect so. The point that you make is also quite right, which is, you know, Ireland already has a bigger chunk of its overall tax take from corporate tax than most other, we'll say, OECD jurisdictions.
Interesting.
Okay? Yeah. Okay. Which is, there's this really funny kind of thing that goes around in the media, you know, is Ireland a haven on one level, but then Ireland collects too much corporation tax on another? I don't understand how the two meet.
Because I think the OECD average, I just read this, is something that's less than 10%. It's like, I want to say it was around 9%. We could probably look that up. And so I'm guessing what you're saying is that, and the US is significantly lower than that. I don't want to quote. I'm not exactly sure what the number is.
Corporation tax is a portion of our overall tax. Yeah, we're north of 20, I'm pretty sure. Now, I could check that. But like our corporate tax take since 2014, right, has gone from about 4 billion to over 23 billion. I want to check those numbers. But so there's been a significant increase in corporate tax over that time, right? And that's been, look, there's been a confluence of factors there. There's been companies who've brought their intellectual property into Ireland post the grandfathering of the double Irish regime. There's also, frankly, the first BEPS project said, as I said earlier, you needed to align substance with taxing rights, okay?
Yeah, the concept of dumping functions.
Exactly.
That really encouraged companies. We saw that in the US too, of companies bringing their IP sort of back or onshoring it closer to where they had the substance. And I think that was a very successful part of the project for policymakers.
100%. And from an Irish perspective, Ireland has always been interested in substance-based investment. So you had a scenario where it was kind of like, okay, out of the places where I could hold IP, where do I already have substance? Ireland is one of those places, you know, it's in the EU, it's got all these things going for it. So actually, Ireland is going to be the place where I'm going to double down. So I think that we've done well from that. We also have some really large taxpayers for in the country. And that actually gives us a bit of a concentration risk that the Department of Finance regularly talk about, so that we have a concentration risk because, you know, 10 taxpayers pay more than 50% of our overall corporate tax. So they would say that we have a concentration risk there, so we can't necessarily always rely on the amount of corporate tax that we have at the moment. So some of that is being put aside into kind of like sovereign wealth funds. Now, not at the level of other wealth funds,
sure.
But they're trying to set up some wealth funds for kind of rainy days and for, you know, decarbonization, things like that.
I mean, that's fascinating, and that I didn't appreciate that governments had contemplated concentration risk. It's certainly something that we think about in the private market and the private industry. But it's interesting that a country like Ireland that has such major multinationals, I get it. It is concentration risk, and it's fascinating to think of policymakers thinking about it in that context. All right, so let's move now to the status of Pillar 2 in Ireland. And so maybe you can remind our listeners, where are we? Obviously, you're part of the EU directive, but just kind of the IR, UTPR, QDMTT, and then we'll talk about some of the pieces of that.
Yeah, first point to note really is that policymakers in Ireland are extremely focused on ensuring that Ireland's regime is qualified in every sense, right? So we want to make sure that from a peer review perspective that Ireland passes with flying colours for obvious reasons, right? You know, you want to make sure that you have a qualified income inclusion rule. You want to make sure that your QDMTT is qualified as well, right? So,
and that prevents other countries, if they would say that you weren't qualified, from potentially being able to collect the top-up tax, and you're particularly ripe for it given the 12.5% statutory rate. So that certainly makes sense. Like, hey, we want this thing to be qualified both for IR and the QDMTTs.
100%. So that's the point that's worthwhile saying at the start.
Yeah.
And then when you look at, okay, so where are we? Well, we're where we should be, right? In that kind of context. So Ireland has adopted the EU directive. Okay, so we do our tax lawmaking at the end of the year. So between October and the end of the year. So we had our budget in October and our finance bill then later in October, which then kind of goes through the different phases and was signed into law by our president in the middle of December, right? So we brought all of that in. That also brought in any guidance, so any administrative guidance that was already issued at that point in time.
Which I think were two at that point,
Yeah.
right? So we had model rules, commentary, and then before December, we had two sets of the July and the earlier February administrative guidance.
Exactly.
Okay. So all those were brought in.
They were brought in. Now, we don't actually write legislation for those. It was just, it's noted, as we do with our transfer pricing regime, that the OECD guidance would apply, would apply from an Irish perspective, right?
And this is fascinating. Can I pause
Yeah,
you
yeah,
on
absolutely.
this? Because I do want to come back, because I think you're one of the few jurisdictions in Europe that is taking that approach.
Yeah.
And just to be clear, what you've done this again from a transfer pricing perspective in Ireland is that future administrative guidance kind of automatically becomes Irish law, if I've got this right, or is there a process that needs to take place? How does that kind of get incorporated?
Yeah.
Because, there was administrative guidance that came out in December, specifically related to the country by country reports. We've reported on this, so we talked about this here on the cross-border tax talks, and we've got more administrative guidance coming. So how does all that, how will that work going forward?
Yeah, so it doesn't automatically come into place in Ireland. What happens in Ireland is that the law that's been set out has given powers to the Minister for Finance to bring in what we call a ministerial order. So it's kind of like secondary legislation.
Kind of like our regulations in the US, it sounds like.
So he could sign a ministerial order at any point in time to bring in guidance. So,
Got it.
So, for example, as I say, the legislation was finalised in mid-December in Ireland. And then we got the December administrative guidance on the 18th of December. The minister adopted a ministerial order on the 20th of December, bringing in the 18th of December 2023 administrative guidance. So that's kind of how that comes in. Now, I think that even gives an interesting point for the future, right? Because you're also asking, well, what's going to happen in terms of future administrative guidance? I think that I would hope that there's probably going to be some consideration and thought given to the way that Ireland really quickly jumped on the December guidance, right, where maybe other jurisdictions didn't. And why I'm saying that is because, as you know, and as you've gone through, there's the anti-arbitrage rules in the December guidance, and there's two dates which apply for those, right? So one is 15 December 2022, and the other is 18 December 2023. We're unclear at this point in time which applies in Ireland, right? And so I think for future administrative guidance, it's probably likely that Ireland may be more contemplative in terms of when they would apply those, or when the minister would come out with a ministerial order. I would assume that the reason that they did it was so close to year end, and they wanted it to apply because that's kind of what the OECD would have wanted in a best case scenario.
So the income inclusion rule, that applies 2024.
2024, yep.
The QDMTT.
2024.
And then
UTPR 2024.
And that little UTPR legislation's already enacted, so we know that's going to be turned on in 2025. Any information on filing? So this is a question we get a lot. I think most countries at this point seem to have the Globe Information Return. That was prescriptive, obviously, in the OECD guidance to be in 2026. QDMTT's more flexibility. We've seen at least one jurisdiction that has said that they're going to require that QDMTT return in 2025. But where's Ireland? Is that going to be 2026 or 2025, or have they stated?
Yeah, they've stated. So 2026, so mid-2026, along with your Globe Information Return. To be fair to the Irish policymakers, and this is something that carries across not just Pillar 2, but everything else that they do, very good at consultations. So there was a subgroup which was set up by the department with a number of stakeholders. I was one of those, where they went through the legislation. They went through, okay, here's the directive, here's the different points that we have to go through, whether they are technical or administrative, etc. And they kind of talked them out with stakeholders. And so, like, on that point, most stakeholders are saying, look, the longer we have, especially in the first number of years, to be able to do this, the better. So they went with the kind of mid-2026 date for QDMTT, along with everything else.
Which I think gives, frankly, a lot of taxpayers and advisors some welcome breathing time, but still a lot of work to be done before then, but we'll get back to that. You had mentioned earlier that, frankly, there, by design, are not a lot of differences from the model rules, commentary, administrative guidance. But one of the interesting things to note is the QDMTTs, because in addition to filing requirements for the QDMTTs, I'm I'm also fascinating and following very closely whether for QDMTTs use local stat accounts or the financial accounting standard of the ultimate parent entity, and have found it interesting that the UK is saying the financial accounting standard of the ultimate parent entity. So if you've got a UK sub of the US, you're going to have to do that in US GAAP. Most of the countries in the EU, it appears, are looking at local stat. Ireland had a little bit of a wrinkle to that. How does the rule work in Ireland for whether for QDMTTs use local stat or the financial accounting standard of the ultimate parent entity?
Yeah, so the rule effectively in Ireland works that you have to use local stat, okay, unless all of your year ends don't effectively line up. Okay. So if you've got companies with a different year end within your Irish group, well then you'll actually revert to the UPE gap, which is kind of interesting because clearly companies will have to have, members within their Irish group who are going to have to change accounting periods, or you're going to buy something with a
if you just did a deal
100%.
or that, I can see where that's where I've seen that rule kind of come up. All right. So what about tax incentives? And so that, Ireland has always had such a low, I say always, since 1997, since I've been practicing, a low corporate tax rate. What is are there incentives in Ireland? And, are there things, particularly from a Pillar 2 perspective, like, obviously the R&D credit has been an issue in a number of countries, but talk a little bit about the incentive regime, if it exists, and how it could potentially be impacted by Pillar 2.
Yeah, so our biggest tax expenditure in terms of incentives is our R&D regime, right? And we again, this is where the Irish Department of Finance are very consultative, right? So they consult a lot with stakeholders, because we immediately saw that our R&D regime a couple of years ago, when we were working through it, we were like, our R&D regime would not be qualified refundable tax credit, right? Like an awful lot of regimes around the world. And so Ireland actually said that they would make a change to that. And they did, right? So they made a change to that over a couple of years. And they also increased the rate, okay, which was also really important. So we had a regime which had a 25% rate. They've upped that to 30%. The reason effectively was because, as you know, the credit was going to be taxed. And so they wanted to make sure that the taxpayer was in the same position. So that effectively the expenditure which they'd kind of ring-fenced for R&D was still going to be the amount that they thought. That, again, gave a lot of certainty to taxpayers on an overall basis. There are we do have other tax expenditures, so like we've film credit relief and some other bits and pieces, and they are not huge. We have a thing called knowledge development box, which is our patent box. No one really uses it. It's very difficult because it's in line with the OECD best practice in terms of knowledge boxes, which is just really difficult for a country like Ireland to be able to adopt, because you need to have all the R&D in the country. Broader than that, it's difficult for a country, one in the EU, to be able to give like non-tax expenses. Obviously we have a grant system, right? But you know, it's in line with what kind of the norms of what you'd be able to give out within the EU. So it's difficult from a state aid perspective to be able to give, massive government grants. Also, from a tax perspective, when you're at 15, you really need to think, if you're not given a qualified refundable tax credit, well, what are you going to give? Because anything you're going to give is probably just going to bring you back up again. Right. So overall incentives, R&D regime is excellent and is very beneficial for taxpayers.
And effectively compliant already because 100%. Of the changes that you made to make this refundable.
Absolutely. Beyond that, I think you're looking at a low rate, wide base, attractive system.
Mm-hmm. All right. So let's move on to kind of process and data readiness. And I'll let listeners know that I think you and I were kind of when this started, we've been working together for a long time, but I don't think either of us were relatively well versed in data and systems. And if one of the things that Pillar 2 has done for tax advisors and tax professionals around the world is that has turned many of us into, I don't want to say data experts, but having to be much more proficient efficient and conversational in understanding what the data requirements are for Pillar 2, particularly those of us that were really just given a lot of deal and structuring advice over the course of our careers. So in that context, what's going on in Ireland for Irish, because I always like to bring in our advisors and folks that, from other countries. What's the perspective for Irish multinational enterprises, Irish UPEs, kind of how are they approaching Pillar 2? Are they all becoming data experts? Do they realize? And, I'll remind also listeners, we're recording this kind of towards the end, sort of middle of 2024, kind of at the end of the initial quarter filing that we've seen for IFRS taxpayers and GAAP taxpayers because of the period accounting for Pillar 2, and still relatively quiet, I think, from a lot of the disclosures and everything that we've seen. But how are Irish multinationals dealing with Pillar 2 and approaching it?
As with everything, there's a mix, right? So, there's going to be some people who are kind of ahead of the pack and are very focused. I would say, and this is as an Irishman, I'm saying it, I would say that we, as Irish people, don't like to meet something head on necessarily, right?
Nice, okay.
So we'll hope that it's going to go away at some point. And so there was probably people who've kind of said, okay, well, I'm doing a deal this year, I'm doing whatever, and so Pillar 2 can wait. Hoping a bit on safe harbors, hoping that maybe I only have a top up tax issue in a couple of countries. I think more and more, you're seeing companies now actually focus on, okay, well, actually, can I even rely on safe harbors for all the reasons that you've gone through before in terms of qualified CBC reports and all that kind of stuff, right? But also then, as you said, focusing on the data, okay? And it's so difficult when you get into it because in theory, I just need these data points. Well, half of them don't exist.
Right.
40 to 60% of them aren't even in your ERP system. So where are you actually going to pull those data points from? And so I think people are kind of getting around to it now. And again, it depends then. We had a bit of a rush post-Christmas where IFRS filers had to have a disclosure, as you know, right? So I had to make a disclosure as to what the impact of Pillar 2 was going to be. And so that was a discussion with the auditor in terms of, okay, where are we? How's this impacting? And how can I prove it to you? Some then didn't. Some were operating under US GAAP, and so then it was quarter one. Was like, how am I gonna get through this? I think it's becoming more and more of a focus nearly every single day that I talk to companies. They're saying, okay, I'm not where I want to be on my data. I'm not where my auditor wants me to be. So, I got through my disclosure, or indeed I got through Q1. They're saying it's going to be different for Q2, for Q3. It's certainly going to be very different scenario at year end. And frankly, it's a bigger task. Certainly the feedback I'm getting is it's a much bigger task than people initially thought because they're just not the owner of that data. Right, so they don't own the data. They have to go and talk to group accounts. They have to go and talk to HR. They have to go and talk to legal, whatever it is. And those people are kind of don't really understand the context. And so what I'm finding is, it takes a village to do Pillar 2, right? And the sooner you can get that message out that Pillar 2 is a tax, but it is not a tax nearly within the control of the tax department. That's where it really becomes real.
Yeah, I think that's a great point. And there is this education that needs to take place to stakeholders. And frankly, this is the same experience that I've been through at PwC as we've had to educate stakeholders that are like, what is Pillar 2? And the people that understand systems and accounting and tax accounting. And so it does require this basic knowledge that we have to transfer to these other stakeholders. And I think just historically, it's like, all right, here's the data that we needed. And I certainly took for granted the data that was needed for even complex U.S. international tax calcs. But now tax is in a very difficult place. You have to educate these stakeholders, and workshops or just things that you can do to try to convince a finance person why they should spend a few minutes understanding what Pillar 2 is and why we're requesting this type of information. And, the recommendation that I would give, you got to start early. And the concern that I have for many taxpayers is that they will tend to wait, as I'm not sure that's just an Irish trait. of potentially procrastinating and towards the end of the year when then all of these requirements and companies are going to want to be as accurate as possible for their year-end financials. Of course, they also want to be accurate from a quarter perspective. But there's this process that needs to take place. And I don't think that's unique to Ireland, and what a big lift, and that many companies are really just starting to see the light and will continue to do so as the year progresses.
And I'm finding, Doug, as well, right, that where it's going well, there's been that education piece, but then there's also been an education piece up, right? So you're talking to your peers. If you're a tax director, you're talking to your peers in terms of, the group accounts people or your legal, treasury, whatever it is, right? The piece upwards is to the CFO and explaining to the CFO how incredibly complex this thing is, because to be fair to your average, incredibly busy, very bright CFO, they're looking at a new tax, and we have new taxes every year, right? In whatever jurisdiction, there's going to be a new tax that's probably going to hit you. And that's just taken as a given, right?
Right.
It's not taken that this is going to be a heavy data lift. It's not taken that this is actually going to be quite a cost on the company. And I'm not even talking about the extra tax that you may or may not
just
have
the
to
process,
pay.
the compliance.
Just the process and the compliance to be able to do it. So I think educating, and a number of my clients have asked me to talk to CFOs, right? And that's been interesting, those conversations, because they start to understand the impact it's going to have.
And the gravity of it. For sure. All right. So I'm going to ask you 2 crystal ball questions with respect to Pillar 2, because I can't resist. And then we're going to end with some other Irish updates and when Ireland is going to bring us the participation exemption that we have been talking about for my entire career. But so that's the hook to keep the listeners listening. My first crystal ball question for you. And I read there was an article a couple weeks ago in Tax Notes that reported that the EU is delaying DAC 9. I'd actually lost track of the DACs. I'll admit. DAC 9 is the information exchange for Pillar 2, and that they're going to be delaying DAC 9 until administrative guidance is finalized. And then they quoted that. I was like, somebody in the EU thinks that the administrative guidance at some point will be finalized. Peter, will the OECD's administrative guidance, will this ever be finalized? Can we have any expectations that this will ever be finalized?
No, certainly not while I'm practicing, I'd say, right? As in, we were talking about this earlier, right? Pillar 2 is hard. It's just really hard, and it's really uncertain. And to be fair to policymakers, right, that's difficult for them, because they're taking these rules, they're implementing them. They have people like you and me going back and saying, what does this mean?
Yeah, what about this?
How does that
what about
apply?
this? What about this?
And so I think that there's going to be rounds and rounds and rounds of guidance. I just think that that's going to be the way. And then what concerns me, I suppose, is that guidance turns into new rules like we've seen, and that's where the game changes, right? Yeah,
that's where it really becomes difficult for taxpayers to comply, and for those of us that are building those compliance engines, it becomes very challenging. All right, so. Not gonna, and I'm with you. Like with this, and we've seen this like in the U.S. with GILTI, which is an income inclusion rule, way less complicated, single country, based on U.S. tax principles, or say single country, blended regime for tax purposes. And we continue to get guidance in the U.S. on GILTI and continue to have open-ended questions. And again, that is just that Pillar 2 is exponentially more complex with that many more questions. So, all right. My next crystal ball question for you. Fast forward to 2025. The UTPR kicks in. My speculation is that Pillar 1, that the U.S. Congress is not going to approve Pillar 1, and that is going to go away. We're going to see considerable DSTs, the digital service taxes, enacted by a number of different countries. How are governments and taxpayers going to react? I mean, there's considerable concerns and issues with the UTPR just from is it compliant with the treaty? And we know the OECD as well as the EU have been out with some analysis supporting that. There's questions about investment treaties, but I mean, is 2025 going to be the most uncertain time for international tax in our careers? Because I didn't think that was possible. And we keep getting, and by the way, we're also likely going to end up with some form of U.S. tax reform as we think about expiring provisions in the TCJA. So what is your outlook for 2025, Peter?
Yeah, I actually feel for a lot of countries with the UTPR, right? Because I don't think they want to apply it. Okay, like I can't speak for Ireland. I'm not sure that Ireland wants to. If you're a cog in the wheel of a US multinational, do you really want to tax the US? Right? It seems like
or any of its subsidiaries.
Or any of its subsidiaries,
yeah.
Exactly, right? So it's kind of nothing necessarily to do with you. I think most countries, policymakers would say, well, look, I'm happy to tax my stuff, okay, and anyone else tax their stuff. Or you would hope that that's the case. So I think the UTP are actually getting turned on if that is the case. And like, as I say, it's legislated for in Ireland.
It's enacted in Ireland.
Yeah, absolutely, as it is in a number of other countries. So I think that is a concern. And I think it's probably something that's not being necessarily thought through, right? Would be an issue. Like, I'm not sure how many groups are forecasting for that. I don't know when you look at their ETR forecasts. I think when you add on, as you say, when you add on any other changes, including US tax reform, I just think 2025 is going to be another difficult year, right? As in, like, I'd like to say a difficult year, but we just keep seeming to have difficult years, right?
Exactly.
In terms of, like, if we go back over the last 10 years, we've had ATAD, we've had Pillar 2, we've had ATAD 2, we've had everything, right, coming at taxpayers. We have so much more in terms of transparency, and then suddenly you're actually now going to have to pay tax on something that no one really wants to collect. It's going to be a funny time.
It is job certainty for tax professionals, and another reason why we need to get young people into the profession and doing international tax. And I mean, it's one of the motivations that I have for doing what I do here on the Cross Border Tax Talks podcast. We need more people doing this, and it's fun. Yeah. All right. So last question for you. Some other Irish updates. So kind of stepping away from Pillar 2. One of the things I teased you a moment ago that we've been hearing that Ireland is going to effectively change their rules with respect to how they tax foreign subsidiaries of Ireland and adopt a participation exemption. Is that going to happen? And what other changes might be on the horizon briefly from an Irish perspective?
Yeah, sure. I've been promising the participation exemption for quite a while.
I know you guys
We're actually getting one this year, right? So
it's really going to happen.
Yeah. So the Department of Finance launched a consultation in March, I think. They launched a consultation which was clear that we will be bringing in a participation exemption on dividends. They did not give legislation in that. They gave the kind of a straw man of what it could possibly look like. They caveated saying we could change it. It looks like it's going to be relatively broad-based. There's a couple of things that probably need updating. They've restricted it at the moment to EU and DTA countries, so treaty countries.
Okay.
I think that will get expanded, right? We've had some discussions with them. It would be on an election basis on a company, so a company could elect as to whether they were going to have the dividends coming from their subsidiaries to be exempt or not, right? On a company.
Could they pick
basis.
each on a CFC on a foreign sub by foreign sub basis?
Not per what they're saying at the moment.
Okay.
We actually wanted
company
it to be
being
done,
the elected at the top of the house.
We actually wanted it to be on a dividend by dividend basis. At least they've gone by company, not in all jurisdictions.
Got it.
Right. So,
okay.
But there's still room to be played. I think the key message is it's coming. It will be here in our finance bill later in the year. A branch exemption is probably a little less certain, right? So they've said that they're still assessing whether they will or won't bring in a branch exemption. Yeah. So we have to see on that. So that's key. Been promising for a long time, so I'll take credit for it now.
All right.
In terms of other developments in Ireland, I think the path, and certainly what we've been suggesting to the Department of Finance in our own pre-budget submissions, is that the path needs to be towards simplification, right? So as we were saying earlier, you want to be at the bottom, right, when you're a small open economy. There's only so much you can do in terms of incentives, and you need to look at what everyone else is doing and make sure that you're kind of best in class. But simplification is a huge item for Ireland, right? So if you think about it, this is a broad brush statement, but most people are going to pay tax on the basis of Pillar 2. Yeah. Okay, so as we said, 12.5 is less than 15. There'll obviously be some who, when you put the changes through and you put the add-backs and deductions through, you'll be above, but most people are going to pay on the basis of 15. So why do I have to deal with all this complex legislation as well? And so that's a path that Ireland are going to go on. I think, participation exemption, as I said, is coming. That reduces the complexity in relation to that we have on our credit system. They've said that they're going to look at over a multi-year basis our interest rules, which are very complex.
Yeah.
So, simplifying our interest rules. They're trying to simplify some business incentives. So I think a path of simplification, we actually believe, will be a key item. And then I also believe that they're going to use tax policy on a broad basis to help with decarbonisation, right? Because tax policy can really be a lever there.
Well, as those developments happen, we'll have you back on to discuss those here on the Cross-Border Tax Talks podcast. Peter, thank you very much for joining. It was a great discussion.
Doug. It was great to be on.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Peter Reilly, PwC Ireland's tax policy leader. I'm Doug McHoney, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.